Do you know your credit score? Even more important, do you know how to manage your credit score? To have credit means someone is willing to loan you money in exchange for your promise to repay it, usually with interest. The higher the interest rate, the higher the total amount you pay to buy something on credit. For instance, if you have good credit and you buy a used car for $5,000, the 5-year loan comes with an interest rate of 5%. But if you have less than perfect credit, your 5-year loan for $5,000 has a 12% interest rate. Watch how much more in interest you will be spending over those 5 years. The loan with the lower interest rate will have you spending a total of $661 in interest. At 12%, you will spend $1,647 in interest. That's more than double. There are 4 common types of credit. 1. Credit cards, a short-term loan used to purchase items that can be paid off by the end of the month. 2. Installment loans, like an auto loan. 3. Student loans, to pay for college. And 4. Mortgage, a loan to buy a house. All of these can come from a credit union or bank. A credit score is based on 5 main components. 35% of your credit score is your payment history. Your payment history includes any late payments, collections, or bankruptcies. The more recent the activity, the worse it can be. 30% is made up of outstanding debt. The more outstanding debt you have and the closer you are to your credit limit, the lower your score will be. Try to keep your credit balance at 25% of your limit or less. 15% of your credit score is the length of your credit history. The longer your overall credit history is, the better. That is why it is so important to establish a strong payment history from the beginning. 10% is all your new credit. Any new credit will impact your score. Credit increase in the last 12 months and new credit will have an impact even if you are not using it. And the final 10% is made up of different types of credit. The types of credit you have is important too. Try not to have more than 3 or 4 revolving accounts, like credit cards and lines of credit. A credit report is a record of your personal financial transactions or credit history. Lenders look at this to see how well you can manage credit. The score is a number between 300 and 850. You want to be as close to 850 as you can. Keep in mind though, your credit score is not just for lenders. Your credit score can affect you when renting an apartment, applying for car insurance, and when you apply for jobs. This is why it's so important to always maintain a healthy credit history.
This video is made possible through a grant from the Pennsylvania Credit Union Foundation in cooperation with the Erie Federal Credit Union.